video is not intended as financial or investment advice and is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie. Let's take a look at the midweek market update. Crypto news has been fairly quiet over the past week. I'd say the two biggest items were the stablecoin bill put forth in the US House that would ban algorithmic stablecoins effectively, as well as the announcement by NASDAQ to get into the crypto custody game, both items kind of addressing what has happened or what the market has dealt with over the past few months in regards to custodians and stablecoins. If we look at the stablecoin wars and see who the winners and losers have been over the past couple of weeks here based on circulating supply, Tether in the orange there, USDC in the yellow, BUSD, Binance's stablecoin in the blue, and then MakerDAO's DAI in the pink. BUSD has continued to see increases in circulating supply as they are getting connected to more and more networks. So the interoperability is rising, but also cleaning up their exchange pairs and kind of forcing everyone to use BUSD as the exchange pair. Certainly helps from a liquidity side of things. And USDC has kind of fallen off here as opportunities to park cash in vehicles that gain interest are on the rise, and stablecoin yields have been kind of flat. Depends on where you're at, but I don't have GUSD on this chart, but Gemini offers a 7.15% yield on their stablecoin. So definitely some nuances between all the pairs. And unlike stablecoins, Forex has had quite the week here with some pretty wild moves. Looks like traders were quoted as saying it resembled a casino, and that's understandable. If we look at DXY, British pound, which may be the British ounce now, and USD-CNY. USD-CNY is being devalued on purpose. They're easing over there in China, and you're seeing CNY rise above that 7 level. This is a multi-decade high, I believe, at this point now. And the British pound looks like it was a reaction to policies over there by the government in regards to energy price fixing and tax cuts. So not necessarily dollar strength in either case. One is purposeful easing, another is government policies, but this has definitely had effects on the volatility of foreign exchange in ways that's even bigger than crypto, definitely, at least recently. And I'd certainly like to see this kind of activity, except on the inverse for the DXY, where we have this blow off top. When you see candles like this, you can categorize it under the dragonfly candlestick pattern. Certainly doesn't mean it's a bottom, but it does tip the probability towards bearish exhaustion, just capitulation, fear, whatever it was down here, right? Margin calls, a bunch of stuff. The likelihood that that can continue at that pace is quite small. So we'll see really these types of candlestick patterns confirm on the next week. If next week you get a candle body that exceeds the wick, then you can say, okay, it's game on, right? That is continuation. But if you get a candle that does not exceed the wick of the previous, then there's a pretty good chance that this chart would form an interim bottom. So that's what I'd want to see for the DXY on the inverse. Basically a shooting star is what it's called. An inverse dragonfly, however you want to think about it. But we're definitely not quite there yet. The euro, which I don't have on this chart, continuing to see weakness, and that's fueling the DXY. So it's almost surprising that crypto's doing as well as it is relative to all of this madness going on in the world. Flipping gears to on-chain activity for Bitcoin and Ethereum mainly. These have been relatively flat over the past couple weeks, past couple months. Nothing new really going on here, and is understandable. If price is muted and down, you generally see less on-chain activity. That's historically what's happened. And with the rise of layer 2 alternatives, this is the Lightning Network. So this sits on top of Bitcoin effectively, much like a debit card system. You put your BTC in a smart contract. The smart contract tells the Lightning Network that you're holding this amount of Bitcoin, and then you're free to transact in a bi-directional manner between anyone else in the Lightning Network. So a good proxy for adoption of this is to look at the total capacity in the network in terms of Bitcoin, and that's approaching 5,000 BTC. Based on the circulating supply as a percentage, that's not that much, but it is rising, and it is rising pretty rapidly. So this does tell me that more and more people are using the Lightning Network, right? Slowly but surely, this is taking years to see adoption, but we're getting there as far as layer 2 is concerned. Something else that Lightning Network sort of unlocks is this ability for microtransactions to make more sense. It's more advantageous to send microtransactions on Lightning. After you open a Lightning channel, costs are effectively free. There is like an onboarding fee effectively, but once you're in the network, transactions are extremely cheap, pennies or less on a USD basis. We can also see how the network's doing from a mining perspective and mining hash rate, where the compute power on the network's at an all-time high here. So this tells me a few things. Miners are continuing to build out previous already planned infrastructure, or they're finally getting their ASICs, they're unpacking them, they're attaching them to the network, right? This stuff takes a little bit of time between ordering the hardware, shipping the hardware, deploying the hardware, right? Finding where in the world you're going to put that. All that is taken into this equation, and then it finally hits the network. So even though price is flat or declining, especially since all-time highs, we're still seeing deployment of hash rate. Now, you could argue that we won't see a bottom in price until hash rate declines significantly. That's what we've seen previously in previous bear markets. That doesn't mean we'll see it in every bear market, but you can see how that looked in 2018, where hash rate almost was reduced by 50%. This hash rate reduction here was when miners were banned out of China. So it's a little bit different. It wasn't necessarily price. It was government regulations in this case. But from here, hash rate looks incredibly healthy from a network security perspective. And if we want to dig into some on-chain stuff that I don't normally talk about, but it's sort of bubbling up recently, we can look at every single coin that's ever moved, every single SAT, which is the smallest unit of account on the network, see when it's moved, at what Bitcoin price it's moved, and then we can sort of formulate metrics around that. And we can separate short-term holders from long-term holders. So short-term holders would be coins that have moved within 155 days. Based on Glassnode estimates, that's sort of the point where you see cold storage versus day-to-day use is 155 days. And when you map this onto price, you get some interesting observations. You can see that when price has historically been at all-time highs, we have seen a significant rise in the green, the short-term holder supply. So we get a lot of tourists, a lot of traders, right? Sort of hop on for the ride. And you see the long-term holder supply drop down as price goes to that all-time high. Part of this also is people who had old and cold storage moving that cold storage and selling, right? That's just part of what we've seen even dating back to 2013. And we certainly saw that rise in short-term supply, short-term holder supply during the most recent all-time highs. And we can take that a step further and we can look at the total supply in loss of the long-term holders. Again, does this affect my trading decisions personally, or just give me interesting data points? It's more of the latter. But it does show you, based on cost basis, relative to previous bear markets, we're seeing a similar number of long-term holder supply in loss relative to their cost basis. And we can also look at aggregate cost basis of the chain relative to market cap. And when cost basis is below market cap, we typically enter these accumulation periods, or the depths of the bear market, right? The doldrums of the bear market. You can see that in 2015. This was around 250 days. You can see that in 2018-19, where we sat in this level for 150 days. And you can see now how we are sort of in that chop based on this metric. So collectively, the on-chain data helps me assume that we're closer to a bottom than a top. Certainly. I think that's fairly obvious. It doesn't tell you that the price is any less bearish, but it does kind of tell you that the people that are holding, they don't have anything worth selling here, right? Because they're underwater effectively. So the unrealized profit is non-existent, right? Depending on how you want to slice and dice this. And the inverse is true at these all-time highs. Unrealized profit eventually gets so high on a relative basis that it's unsustainable, and that's at peak euphoria, at peak blow off top. That's sort of what we get. And that's illustrated here where the market cap is several multiples above the cost basis. If you look at Ethereum is also, from an on-chain activity perspective, mainly flat, really since the beginning of 2021. This is a monthly average of transaction counts and active addresses, just as a proxy for activity. And you're still seeing significant amounts of activity, but you're not seeing week over week continuous rises in activity like you were beginning of 2020 or beginning of 2017, right? Things certainly look a little different now. And if you look at that in comparison to price, it's unsurprising that on-chain activity peaks or has peaked during all-time highs in price. So again, on-chain activity and price very closely related. If we do a quick check-in on hash rate from ETH, where it went, one possible place was Ethereum Classic. And you can see in the red here, we did have a slight uptick. Well, you could say a significant uptick in ETH Classic hash rate after all the hash rate from Ethereum got booted off the network as it went from proof of work to proof of stake. Less than I'd expect, but probably as much as the network could handle based on mining profitability. So if you're not profitable as a miner on Ethereum Classic, you're probably not going to bother mining on Ethereum Classic, just based on math, right? If we look at GPU cost, this is a high-end GPU that could potentially have been used to mine Ethereum. You can see how that has cooled off significantly, right? We were seeing $4,000 prices in early 2022. This is PCPartPicker.com. And now those prices are down sub 1,000, right? On average, certainly down significantly as well. So the mining aspect for GPUs has declined as Ethereum has booted them off the network, which makes sense. Two of the biggest things that matter now for Ethereum in my mind are Ethereum burning component. So in August 2021, they introduced a fee burning mechanism where a percentage of the fees get removed from the circulating supply. You see higher burns with more on-chain activity. So with the current environment, you're seeing very little burning activity. After the proof of work to proof of stake transition, issuance went from 4% to effectively zero on the network. So this has the chance to go negative, to go deflationary from an issuance perspective if the fee burning mechanism kicks in. Now, the other half of this equation really is the validators, and you can send 32 ETH and make a validator, or you can send a portion of 32 ETH to a pool, and it will pool up to 32 ETH together and make a validator. So if we check on those validators, we can see that they are still being created. This is a number of new validators. So that supply soak is still happening. And the total ETH locked now is approaching 14 million thereabouts. So more and more of the circulating supply every day is being locked in validators. We can also look at the validators and make sure that none of them are misbehaving or none of them are accidentally losing their stake. So slashing is what happens when the network identifies a validator misbehaving or deviating from the expected behavior, let's say. So it looks like there was an uptick in slashing events over the past 4 or 5 days, and we can check to see who those were, what they were doing, and the network sort of tells you, okay, all of these nodes here or these validators were what looks like, as explained by somebody on Twitter, sort of trying to double count themselves, probably not on purpose. It was probably a redundancy setup. But these nodes did get slashed. Sorry, I keep saying nodes, validators. These validators did get slashed because of this activity. Now, it wasn't necessarily malicious, but it was against the rules, and the network doesn't know that it's not malicious. It just knows that it's against the rules. So that's why they got slashed. Flipping gears to technicals, not too much has changed on the technical front either. Over the past week, we still have this high time frame logarithmic regression, power law corridor as it's referred, for Bitcoin, and we're still well within the projected ranges based on the previous 3 all-time highs, which is when this was created. So it is a line of best fit to the previous 3 all-time highs. It's important people know that. It's not some magic levels that were drawn on here. So again, much like on-chain activity, this does tell me we're probably closer to a bottom than the top here at this point in time. Now, if we add some annotations to this and make it semi-busy, now we can look at how this looked during previous halving cycles in the red highlights here, how it may look during the next halving cycle, how we sort of ride these lows into the halving cycle, where we are relative to previous all-time highs. This isn't my favorite type of analysis because I think each cycle is slightly different, but it does give you some idea of what's going on here when we're looking at duration of drawdown, percentage of drawdown. If we're trying to figure out where might this go based on previous drawdowns, 80 to 85% is somewhere in the ballpark of where we've gotten on the previous bear market bottoms. So it wouldn't be unreasonable. We're at around minus 73% now. You can see based on the halving cycles, we're kind of in between halving cycles. Historically, we tend to peak a year after the previous halving cycle. So that is in the rear view now. And that helps me in my mindset of setting expectations for DCA type activity and accumulation or semi-unexciting range trading type of behavior. Any way you try to slice this, we've got some time still, to figure out where the bottom actually is going to be. But ultimately what we want to see is an extended period of time at some fixed range. Currently, we're about 115, 112 days into the current range. Now, what's more concerning to me in the near term is this trend channel, which we continue to be held within. Even today, where overnight we peaked up above 20.3K on BTC and then got smacked all the way back down to 19 throughout the day. So I'd certainly feel more comfortable that lows were in if we were back above 200-week MA, 200-day EMA, certainly. We're still sitting around previous all-time high, but it still looks as though people are more excited to sell than buy at these levels. And if we map out two scenarios, we can either say, okay, what does this look like? What does the pattern matcher say? Potentially double bottom, right? We are probably 2 to 3 weeks, maybe a month out from really deciding what that may look like. This is a type of Adam and Eve, double bottom, a V and a U, potentially, right? We'll see what this looks like relative to the 200-day moving average. But what I would love to see from a bullish perspective is a completion of this pattern at the 200-day moving average with resistance level around 25K, because then we have confluence for moves back into the previous consolidation range. So this is the bullish case, which says we're in the process of forming lows now. Now, the bearish case is either the current consolidation is some sort of non-specific bearish chart pattern, or we could set ourselves up for an inverted Adam and Eve type of structure, right? An upside down V and U with lows between 12 and 14, theoretically, based on Fibonacci extensions. I don't have a great read on this one way or the other currently, other than the fact that everything is pointing bearish trend-wise. So it's until we see back above 25 or near 25, activity rising instead of falling, right? At the very least, then down looks like the way in the near term. ETH, very much the same, sort of stuck between all these levels, hasn't really wanted to hold highs, has done better than BTC in the quarter, but has been unable to hold on to those highs that it had pre-merge. And really for me, again, this downward channel is the focus. The first step towards a reversal would be an invalidation or an exit of that trend channel. A few other coins that are on our radar here. Atom has done significantly well relative to everything else throughout the quarter, kind of squeezing between the 50 and the 200 EMA here. Something to watch in Q4 is if we get outperformance from a few non-ETH, non-BTC coins that may signal a different direction than down throughout the next couple weeks. Link is another one that quietly is forming this multi-month bottom here. I shouldn't say bottom, I should say range, multi-month range, because hasn't made lows, hasn't quite made highs, just holding these levels. Now, I've been on record many times saying I don't know why the Link token exists. That continues to be the case. I don't know what purpose it serves, but they do have staking coming, allegedly, sooner rather than later, and you may see some speculative fervor around that. But Link as a protocol is great. It's an oracle. It basically fuels all of DeFi and tells DeFi what the prices of everything are. Works amazingly well. I don't know why the token exists, but it does. And as a trading vehicle, this has a decent shot for a move above the 200-day moving average to Q4. Sol is another one that certainly sold off significantly and is holding a relatively tight range here, has held the range since May. So it's one to watch throughout next quarter. Again, if we start to see outperformance in some of these relative to BTC or relative to ETH, that may be a clue or a signal that some risk is back on the table, right? I think in general, there's a muted risk activity. If you can get 4% yield in cash, risk-free, right, in a bank account, why bother with anything risky? But alts may be the first to move in Q4 if things start to look a little better from the risk perspective. AVAX as well, sort of within the range that it's been holding for the past couple months. It has that similar ambiguity with Bitcoin. Could be an Adam and Eve, could be an inverted Adam and Eve. We'll see what happens in Q4. But just like Bitcoin, this 200-day moving average is something to watch for as a litmus test of bullishness or bearishness. DOT, slightly different, potentially a falling wedge situation here that may lead to a reversal, but certainly looks more bearish than Sol and AVAX. And then lastly, just to highlight a chart that looks vastly different than everything else is BNB against VTC, which recently made a new all-time high, which is kind of crazy to think about. But this is where even in a bear market, there are opportunities to trade around on these relative pairs, finding strength wherever you can get it. That's all for this one this week. Like, dislike, comment, share, subscribe, and happy trading.